The arbitrage-free valuation framework is a cornerstone of fixed income analysis and forms the basis for pricing bonds and interest rate derivatives. Arbitrage-free valuation assumes that two assets producing identical future cash flows must have the same price. Otherwise, investors could earn riskless profits through arbitrage. While option-free bonds can often be valued using spot rates, more complex securities require models that account for uncertainty in future interest rates. The binomial interest rate tree framework provides such a structure by modeling multiple possible future paths for rates. This approach is particularly valuable when analyzing bonds with embedded options and other interest rate-sensitive instruments. A binomial interest rate tree is a graphical representation of possible future interest rate movements over time. The model assumes that, during each period, interest rates can move to one of two possible values, an upward path or a downward path. Starting from the current one-period spot rate, known as the root node, the tree expands into a series of interconnected nodes representing future rate outcomes. Because each node generates two possible future states, the model captures uncertainty while maintaining computational simplicity. The resulting lattice structure provides a systematic framework for valuing bonds, derivatives, and other fixed-income securities under varying interest rate scenarios. An important characteristic of the binomial interest rate tree is that the interest rates at each node are one-period forward rates applicable to that specific period. The model assumes a log-normal distribution of rates, ensuring that interest rates remain non-negative and that volatility increases proportionally with higher rates. Adjacent rates within a given period are separated by a magnitude determined by interest rate volatility. This relationship allows the tree to reflect realistic market behavior while maintaining internal consistency. By incorporating volatility directly into the structure, the binomial framework captures the uncertainty surrounding future interest rates more effectively than a single yield curve approach. Calibration is a critical step in constructing a binomial interest rate tree. The objective is to adjust the rates within the tree so that it accurately reproduces the current term structure of interest rates observed in the market. Specifically, the model must generate bond prices that match those implied by the existing spot rate curve. Through calibration, the tree becomes consistent with current market conditions while preserving its assumptions regarding volatility and future rate movements. A properly calibrated tree ensures that valuation results are arbitrage-free and aligned with observable market prices, making it a reliable tool for pricing complex fixed-income securities. The primary valuation technique used within a binomial tree is backward induction. Under this method, analysts begin at the final nodes of the tree where future cash flows are known with certainty. They then work backward toward the present, discounting expected future values at the appropriate interest rates at each node. This recursive process determines the value of the security at every point within the tree until the current fair value is obtained. Backward induction is particularly useful because it accommodates changing cash flows and varying interest rate paths, making it suitable for pricing both option-free and option-embedded fixed-income instruments. For option-free bonds, the binomial model values the bond by calculating expected future cash flows under all possible interest rate scenarios and discounting them back through the tree. At each node, the bond's value equals the present value of the average of its possible future values, adjusted for coupon payments and discounted using the corresponding node rate. Because the model considers multiple future interest rate paths, it produces a more realistic valuation than methods relying solely on a single discount rate. This framework demonstrates how bond prices respond dynamically to changing interest rate expectations and market volatility. The binomial framework becomes even more powerful when applied to bonds with embedded options such as callable or putable bonds. Unlike option-free bonds, these securities have cash flows that depend on future interest rate movements and the actions of issuers or investors. At each node, the model evaluates whether exercising the embedded option is economically optimal. This feature allows the valuation process to reflect the changing behavior of both borrowers and lenders under different interest rate environments. As a result, the binomial model captures the interaction between interest rate uncertainty and option exercise decisions more accurately than traditional discounted cash flow methods. Interest rate models provide the theoretical foundation for constructing and interpreting binomial trees. These models seek to describe how interest rates evolve over time while incorporating factors such as volatility, mean reversion, and the current term structure. The binomial interest rate tree represents one practical implementation of these concepts, translating theoretical assumptions into a framework suitable for valuation. By integrating current market rates, future uncertainty, and volatility assumptions, Interest rate models enable analysts to estimate fair values for a wide range of fixed-income securities. Mastery of these models is essential for understanding modern bond pricing, risk management, and derivative valuation within the program.